First of all, it's worth saying that there's no one-size-fits-all solution. So it really is worthwhile speaking to the taxpayer on an individual basis. You can't just kind of read up about these things and decide, well, that's the way I'm going to go about incorporating my business and think that's going to be the right solution for you. In respect to this particular scenario, I'd be talking to this individual about Section 162 incorporation relief. That's one where you're able to move your business from personal ownership into a limited company, and you're able to hold over the gain. So you're not having to pay the taxman tax immediately upon the transfer of that business to a limited company, because the basic tax rules are such that where you as an individual transfer your business to a limited company, ordinarily HMRC would say, well, a tax charge arises, and they'd be seeking capital gains tax. However, a few years ago, there was a well-known case, and for those of you in property, you may well have come across this. It was the case of Elizabeth Moyne Ramsey, HMRC. And prior to her challenging HMRC always took the view that those that run a buy-to-let business aren't running a business at all, and that actually what they're doing is a passive investment. Elizabeth Moyne Ramsey challenged HMRC in that view, and going through the courts, eventually up to the upper tribunal, she won, and HMRC had to accept that she was running a business, and so therefore she wasn't liable to capital gains tax on the transfer of her buy-to-let business to a limited company. She would have paid stamp duty land tax along the way, however. So that's one possible. Another route that we've been advising clients of over many years is the use of partnerships and limited liability partnerships. And those, again, require bespoke advice based on the individual's circumstances, but can provide, in the right circumstances, a way in which you would be able to restructure your business into a partnership. And then that opens up far more opportunities for further restructuring down the line, which could also involve a transfer to a limited company. And the way in which we've managed to achieve that restructure for clients that have done that in the past has resulted in not only them mitigating capital gains tax, but also stamp duty land tax along the way, and also provided them with a really good structure by which they're able to now consider succession planning. Historically, I've come across many clients who have said, well, I've got this buy-to-let business, I've got 10 properties now. I'm going to give property number 1 to 3 to child number 1. I'm going to give properties 4 to 6 to child number 2, and so on. And in the process, they've been crystallizing significant capital gains tax charges, and also they've lost control of that business, because once the child has taken ownership of that property, they can't control what happens to the income nor the capital value thereafter. And so in the world that we live in now, with divorces being far more commonplace, the families are also finding that the family wealth is actually being lost, where divorce becomes an issue somewhere down the road. So by having a limited company structure, it actually allows the family to retain control of the family's assets and use shares as a means of succession planning down the road.